Yeah. So, man, I'm going to just jump right in with the million questions.
A lot of complexity that goes along with it. So the more you learn about it, the more you understand the nuances of it, the more successful you'll be. And then it's kind of
extended significant capital to research and identify these opportunities, but there's still deals out there.
There are.
You really are reading the tea leaves. Like, you're looking for the path of progress.
Yeah.
Michael and I are hoping that one day a letter will come in and
Yeah.
Okay, cool. All right. Matt Sands, welcome to the podcast. Thank you for jumping on to chat about mineral rights with us.
Yeah, absolutely. Thanks again for having me. I'm looking forward to the conversation.
Yeah, definitely. So this is something that selfishly I think we wanted to have you on because we've been very curious about mineral rights for years. And I'll give you just a little backstory that might be fun and it might be something that you just laugh at. But, we started out in kind of the high volume land flip game, and we were flipping, what we call desert squares. We were buying land in Arizona to start and Colorado, just way out there, very, very far. And it's pretty cheap land. I mean, when we started, we were buying properties for, $1,000 and selling it for $4,000 and seller financing it and all that kind of stuff. And so we've kind of, migrated, I guess, like up the ladder a little bit, and we're flipping, higher value properties now, but we did tons of deals. And at one point we kind of had this idea. We were like, what are we doing with the mineral rights? We see that we're buying properties. We see these mineral rights on the deeds. Let's contact a mineral rights attorney and see if there's some opportunity there. So we did talk to a mineral rights attorney, and I think we spent maybe $3 or $4 just kind of like in consulting on how to sever the mineral rights. And so we created this other entity that's just kind of an entity. It's just an entity for mineral rights. And as we would buy properties, we never did any research to see if mineral rights were there, but we just assumed, hey, if they're there and then if we sever them and then sell the property, at least we'll, potentially own some mineral rights. So we did that, but that is honestly, we never earned a dime from it. We may or may not own any mineral rights. I have no idea. But we pushed paper around on that. And that's kind of like our limited experience with mineral rights. So we're excited to we have a million questions, but we're excited to dive in with you and learn, like, how can we as land investors to kind of get involved with mineral rights and maybe profit off it?
Yeah, that's a great catch. I think your intuition was correct in that thinking that there's value there with the minerals. That is very true. And as your listeners probably know, the mineral estate is part of the bundle of sticks when you are talking about real property and land. And one of those is the right that go with the minerals under the ground. And it's a completely, potentially a separate asset class from surface rights that can be independently bought, sold, leased, inherited. And by severing the minerals is when you can do that. That's when that separates. So that creates what's called a split estate. And so that's when somebody, at some point down that chain of title, they decided that they wanted to convey the mineral rights, but then keep the surface, or vice versa. And, that creates a split estate. And so then those minerals are then sitting out there independently. But, in the situation you describe where you're buying fee simple land, that owns, you're potentially getting the minerals under the ground as well. It may not be explicit, it certainly usually isn't if it's never been severed, that there's no reservation of the minerals, you don't see anything like that in doing the due diligence, then it's very well, it's very possible that landowner still owns the mineral rights. And it's something that is often misunderstood, I think, in terms of valuing those. And we can get into that if you'd like as well. But I think it's, you definitely were ahead of most people, I think, in thinking that there's value there and let's hold on to them if we can, and see what happens down the road.
Yeah. So, man, I'm going to just jump right in with the million questions. So, for those of us who are more novice here, Can you give us just an idea range of everything that could be construed as a mineral right?
Yeah, it really is a very broad term. And of course, the things that come to mind are the real obvious ones like gold or silver. Hey, there used to be a silver mine here. And so there's value in the hard rock minerals. Well, a lot of what I deal with in working with clients and with other investors and people that have inherited mineral rights is the oil and gas that's below the ground. And that is part of the mineral estate. And that is often the most easily understood and most valuable in terms of future cash flow. Obviously, if you have a large tract of land and there's a hard rock mine on it, that's great. And there could be a lot of value there, but it may take a decade for that mine to come to fruition. And there may be a lot of environmental opposition and may or may not ever happen, even if there are minerals there. And obviously, the value in the minerals is when they can be sold and when you can realize revenue from that. And so with oil and gas, there's multiple opportunities to get revenue along that life cycle of getting developed. And it's usually because you don't have to dig down, physically extract and look at it. You can drill a hole and you can reach minerals that are a couple of miles away from a surface location with horizontal drilling. And you probably have heard of hydraulic fracturing. All those things have unlocked enormous potential around oil and gas in the United States. And it's why we're the number one producer globally of oil and gas, is because of that shale revolution that really took place in the last 20 years, where companies and engineers have figured out ways to combine those things that were never done together, where you drill a horizontal well 1 or 2 miles under the ground, horizontally, and then you pump a bunch of high pressure water and sand and things to keep the rock fractures open and to crack the rock to allow the oil and gas to flow. That made certain areas that were previously uneconomic economic to develop and actually profitable to drill for oil and gas. And that's really why things took off about 20 years ago.
How did you get into mineral rights in the first place? Like, what was your foray into that?
So I've worked in the oil and gas industry my entire career. I started out working for a small oil and gas company called Shell, as you may have heard of, but learned a lot about the operator side of things. So that's where they go and they'll lease the minerals and they'll drill the oil. And so I did a lot of planning and scheduling work and understanding the different moving pieces that companies have to to move around to actually go and develop a new asset and to drill for oil and gas. I got interested in about 10 years ago in the minerals side of things. I've always kind of in the back of my mind wanted to do something entrepreneurial, wanted to start my own business. And I had a personal choice. Located in Denver, Colorado. My wife and I are originally from here. Working for Shell, I was faced with the prospect of moving back to Houston. And we just didn't want to leave Denver. So I left Shell and started a company to initially invest in minerals and royalties and to really roll up my sleeves and learn that side of the business. And that has since morphed into a consulting practice as well, where I'll help do valuations and appraisals, and then also do buy and sell side advisory services for clients.
Okay, gotcha. So if someone's starting out in minerals and they just, they didn't inherit the minerals and you're not helping them on that side, but they just want to get started in it, is that something that's like, is it a rich man's game? Or can you start with very little? Can you, like in real estate, for example, you can do a lot of real estate deals with no money and you can basically tie up a contract or tie up a house or tie up a piece of land and then you can flip that contract. Can you do stuff like that in minerals, or do you have to have a lot of money? Like, what does the starting point look like for your average person that, they're a W-2 employee, but they want to get into the game?
You can certainly get started with, doing small deals and then over time build a portfolio of different assets, across different basins or different states and mix of oil and mix of gas. And interesting thing with minerals is because they can be passed down and subdivided. You have people that own an undivided interest in the same tract of land. Maybe it's a quarter section of land, but it's been subdivided, 100 times. And so they own, um, you know, 1/100th of that 160 acres. Or just to make it simple for math purposes, they own 1/160th. And so they own one net mineral acre. Well, that might be worth, a few $1,000s per net mineral acre. So you're only talking about a few $1,000s for a deal. And if you do the due diligence yourself in terms of running title, and then doing the valuation and understanding what type of oil and gas activities nearby and what the future potential is for that property, you can piece together a lot of small deals. I know several people that are full-time employed doing other things besides mineral rights investing, and they do this on the side. And so it's certainly something you can get started small. It's like anything. Of course, there's a lot of complexity that goes along with it. So the more you learn about it, the more you understand the nuances of it, the more successful you'll be. And then it's kind of, I've not done any land deals, but I imagine it's probably a numbers game as well, where your success rate is dependent on your ability to roll up your sleeves and make a lot of phone calls and send letters and find interested buyers. And doing that over a period of time, you'll hit a few that are like, this was a really valuable piece of property that I was able to acquire over here, and that will pay for the 3 or 4 that are just sitting there not doing anything for the foreseeable future. So there's that ability to sort of diversify across multiple properties that help reduce some of the risk. Although there's definitely risk of nothing happening, and so you pay for something that's the term that we use in the industry is goat pasture. That it's not that you own the minerals, but if nothing's ever going to happen there, it's maybe not really worth anything.
Yeah.
Yeah, that kind of leads me to 2 big questions, right? Which are directly transferable in just traditional real estate, where you have due diligence and then you have title, right? And on the due diligence side, I mean, going all the way back to just market selection, site selection, identifying areas that could have deposits, that could have actual minerals of value. I mean, it seems like in today's day and age, a lot of the big corporations, a lot of the bigger companies have extended significant capital to research and identify these opportunities, but there's still deals out there.
There are, it's obvious if you go to the heart of the Permian Basin where they're drilling, a ton of wells, and there's people falling over each other to try to find a deal, that there's going to be a lot of competition, and you're not going to get any like screaming deals, right? Because they're getting unsolicited offers for $25,000 an acre. You can't come in and say, well, I'm going to offer you $5,000 an acre. They're just going to laugh at you and say, good luck with that, because I've got 10 other people that are going to offer me 5 times that. So you'll be quickly pushed out of the market. But there, are areas that are perhaps there's less activity. Certain parts of Oklahoma, certain parts of say Colorado, other states that is activity, there's drilling going on, and it's more of a niche area where it's not as obvious when something is going to get drilled. And so maybe there's a little bit more risk. And of course, that means you can pay a little bit less for those types of properties, because it's all really tied to the prospect of future cash flow from that property. If there's a rig on site today drilling 16 horizontal wells, well, in the next 12 months, you're going to start receiving royalties from those wells, and that's pretty, I say, relatively easy to quantify what that cash flow is going to look like. And so you're going to get a lot of interest, and people willing to pay top dollar for that, versus if you can just leverage your insights and relationships and information to try to find out where those smaller companies, and maybe Oklahoma, for example, where they're going to drill next, and you can start to put together an investment thesis that makes sense for you, that you can be successful. But it's it is a challenge. I will say it's not just something where you're going to immediately come in and perhaps like get that lottery ticket and be retiring next week because you bought the minerals and you're now like the Beverly Hillbillies, right? It's something that is takes time, but if you're willing to put in the work and do the research, you can build a nice portfolio of assets that you can pass down to your kids or have as a real alternate investment.
Yeah.
Yeah. So then, like, taking that to the next step, when you've identified it, the title, um, how do you go about that? I mean, is it just like a traditional title policy, title process with when you're buying a house or a piece of land, or I imagine that it's got some different layers of complexity in there to make sure that you're going down to identify who actually owns those mineral rights?
Yeah, it is. I think in general it's seen as more complex. It's pretty obvious with, well, I'll say that when you convey land, you kind of know what you're getting. You can put your eyes on it. You can see, okay, this person um, built the house there. They have the land. They have physical like ownership of it, and it's kind of, and you can get a title company to give you title insurance for that. So like even if something happens where they were squatting and they didn't really own it, well, you have this title insurance policy, and you got to get out of jail free card to a certain extent. With minerals, there none of that is available. No title company will underwrite a title insurance on minerals. It's just there's too much risk. There's a good chance that somebody thinks they own it and they actually don't own it because of language in a deed that can be interpreted, and based on case law, maybe they don't own it. They've over conveyed interest. They never had it in the first place, and so it's really incumbent on the mineral investor to run title. You have to go from patent to present, so back when that land was patented all the way to present day, and look at that full chain of title and explicitly what happened with those minerals. Like you said, Chris, where you guys have been conveying out those minerals into a separate entity. You've been looking for that language in those deeds where somebody has maybe filed a mineral deed. That surface owner, that person that owned the fee simple land, where they conveyed the minerals. Maybe, and that would be the event where those have been separated, and then from that point, you just have to trace it through time as to who owns it today. And it gets interesting because usually with land, you're dealing with the full, whatever the legal description of that land is, that surface footprint is what you're getting. With minerals, you might have the land description, the gross acreage will be 640 acres. But like I said, because of the conveyance of those interests and the fractionalization over time, you may be looking at like a quarter of a net acre, even though it's 100 or 640 gross acres. So you have to trace all of those things back to the start of when that land was patented to really have a good sense that you're getting what you think you're getting. And that's where the profession that comes in that deals with that is the landman. And so many of you have seen the show with Billy Bob Thornton, the dealing with the cartels and all those kinds of things. I will say it's a lot less sexy in real life. It's a lot of going to the courthouse and looking at all the land records, the deeds, the oil and gas leases, and putting that all together and figuring out who owns what. And that's the person that can really help as you're getting started. In particular, I think as you're doing some of these, running title yourself, maybe you want to have somebody that really knows oil and gas law, and having either a title attorney, oil and gas attorney, or a landman review it is also a really good way to make sure that you're getting what you think you're getting during a land deal.
How do you like what options do you have when you want to monetize? I'd imagine there's, different things for different types of minerals, but can we dive into that a little bit?
Sure. Yeah, there's a couple of key events in owning mineral rights where you can have the opportunity to monetize it. One is when you lease the minerals to an oil and gas company to drill. So if you buy land that is, or you buy minerals that are unleased, part of that mineral estate, you have the right to to drill, and when you sign an oil and gas lease, you're conveying that right to drill to the oil and gas company. In exchange, they give you rent, but they pay it all up front. So unlike like a monthly rent that you're getting for another, like a piece of property that you may own, investment property, it's called a paid up oil and gas lease. So you get the rental payment basically for the full term of that, the primary term of that lease up front. And so most leases are between, say, 3 to 5 years primary term. And that'll be, again, they'll give you, say, $500 an acre or whatever the going rate is in that area for an oil and gas lease. And then you have the right to negotiate the terms of that lease. And one of the most important terms when you're negotiating an oil and gas lease is the royalty rate. So the value of those minerals going forward is directly proportional to the royalty rate that you negotiate, just because that will dictate the future royalty payments if a well is drilled and if it's successful. So the oil and gas lease is really the first opportunity to monetize it. And you don't have to sell it, right? So you're leasing those minerals, and then you hold on to that. And if a well gets drilled, then you'll start getting royalty payments. And so that's the other monetization, is the actual mailbox money, as it's called, right? So you sit back and now you start getting these royalty checks that come in every month as, they produce oil and gas and sell it, and you get your proportional share of that based on, how many net acres you own in that overall unit that the well or wells are producing from. And so that is the other monetization opportunity. And then the last one, of course, is if you flip it, right? So you might hold on to a property for a little while and go through that leasing phase, and then you get some royalties, and then you maybe decide to sell it down the road. And that could be another opportunity to monetize minerals. And so it's kind of interesting because you have multiple opportunities, and you're throughout that process as the mineral owner, you're not putting the capital up to do those things. You're not putting the capital into drilling the well and to doing the exploration and all of the operation, the day-to-day operating expenses for those wells. You're not on the hook for that. Generally speaking, you may have some small percentage of the post-production costs, for gas in particular. There's lots of steps in that value chain it takes to market it, to transport it, to separate out any valuable hydrocarbons from the dry natural gas that can be sold and, to go down to the pipeline to heat your home and stuff like that. So, but in general, it's like you don't have the operating expenses or the capital going into it. So that's an interesting aspect with minerals as well.
Why is it that so many of these operators are leasing the mineral rights as opposed to purchasing them? Or are they?
More companies have gotten into the business of purchasing minerals, for sure. There's an interesting one where Diamondback Energy, which is a big operator in West Texas, their mineral purchasing was called Viper. And so they would go and buy minerals ahead of where Diamondback was going to drill. And so they had sort of control over the timing of when those new wells would come online and when that revenue stream in terms of the royalty payments would come online. And so they sort of controlled their own destiny. That was really one of the first to do that. And that kind of piqued the interest of a lot of other operators that have since formed similar entities to sort of do the same thing, or just to, in general, invest in minerals and royalties to sort of diversify and sort of reduce some of that, the risk that goes along with, the cost of hiring a drilling rig and the input costs going up and, squeezing the margins. Well, they can buy minerals and sort of enjoy some of the upside in terms of the commodity price exposure and things like that, but then maybe not the cost side of things. So there are companies that have done that. It's not widespread. A lot of it's just because they're in the business of drilling and operating oil and gas wells and facilities. And so that's their business model, is to go and lease and then go and drill and deploy capital and to operate and sort of control the whole process and so that's the thing that's really different between minerals and the operated side. Within the piece of the pie when you drill an oil and gas well, a certain percentage of that is owned by the leasehold interest. That's the people that basically took the oil and gas lease. That's the oil and gas company, oftentimes. And then the other piece of the pie is the mineral estate. And so all that has to equal 100%. And again, they're in the business of controlling where they're going to drill, the cost inputs. They're in control of the cost, and that's kind of their business model, is to be in charge of, okay, we're going to go drill in this area here. We're going to, come up with a new way, a new formation. We're going to go after, be in control of that, because they are the ones deploying the capital and making those decisions. Whereas in the mineral estate, you're sort of along for the ride, and so that's a slightly different aspect, that you're really at the mercy of the lessee of the oil and gas company as to when something happens, how many wells get drilled, those types of things. So it's kind of an interesting dynamic there.
Aside from oil and gas, do you primarily focus on oil and gas, or do you focus on any of the other minerals that are under the ground that people might be able to monetize?
The other one that's probably the most closely related is lithium. That is something, of course, that's become very much in demand because of rechargeable batteries, EVs, and so there are certain parts of the country that, like in Northwest Arkansas, or I'm sorry, Southwest Arkansas, where they have a lithium deposit there that they can drill and produce water, this brine that's very high concentration of lithium. They can extract the lithium out, re-inject the water, and they're using oil and gas drilling techniques, and oil and gas companies that are often doing this. And so that's the one area that we've been following probably the most closely. I have not really dealt with any of the hard rock mining stuff, any of the critical minerals, anything that requires you to mine ore and then process it. That's a different business and sort of a different ball game. So that's not something I've really dealt with. But
Gotcha. So when you're doing this, when you're going to go try to acquire mineral rights, you're very geographically focused, right?
yeah, for sure. It's really where, and it's pretty obvious. I mean, it's not something where you have to do a lot of guesswork. You can see where there's other activity going on. That's a good place to start. You don't want to go into some area that nothing has ever been happening, but you heard from, your friend's cousin who's a geologist that this is a really good area for oil and gas development, that, there's a lot of risk there versus they're drilling today on these tracks. And if I can get minerals that are 1 or 2 miles away, then that's, and they're moving in that direction. Well, it's probably a matter of time before something happens. Certainly, maybe there's interest in leasing your minerals, if nothing else. Even if a well doesn't get drilled, you could potentially lease them. So you can kind of read the tea leaves just by looking at where activity is occurring to figure out areas that are desirable for oil and gas mineral rights.
Okay. So you really are reading the tea leaves. Like, you're looking for the path of progress, and then you buy, and you buy that square on the Monopoly board, and then you hope someone's going to pass by and then, need to land on your square, right?
Yeah, exactly.
Yeah.
And the way that you can do that, there's lots of public documents that are out there, certainly in areas where statutory pooling is a thing, and that's where different mineral tracts can be pooled together so that a long horizontal well could be drilled. And oftentimes they're pooling minerals in, 2-3 sections of land together to drill multiple horizontal wells. Well, the State Oil and Gas Commission, wherever that's occurring, has process for doing that. Give Oklahoma as an example, the Oklahoma Corporation Commission oversees that process. And so a company will have to file an application to pool that acreage together and, identify all the interested parties as part of that process so they can notify them. So if there's any objections, they can go sit through the hearing and raise their hand and say, no, we don't want this to happen or whatever. So that is an area, that's a source of leads potentially, is through those pooling documents. You can see the mineral owners that have an interest in those units that are being proposed. And that's usually a year or more out before wells are even permitted. They have to get that acreage pooled together. And that's because they can go lease as much of this acreage as possible. Just the fact of the matter is they're not going to be able to get 100%. So that's the process where there's somebody that will look at that and say, okay, you gave those people a lease offer. They had the opportunity to lease, whether they decided not to for whatever reason, or maybe the heirs of that original property owner couldn't be located, and so those interests still exist under that family, but some mechanism has to be in place to give them some compensation for that process, and so they set a royalty rate, a minimum royalty rate based on the that whole pooling process will dictate what the terms of that are and what the statutory minimum royalty rate for those mineral owners that are force pooled, and things like that. So there's, from an investor side, that gives you indication of that company's plans, because they wouldn't go through that whole process of forming that unit and all the regulatory and permitting and leasing things that are involved unless they plan on drilling a well. So that's a good indication that there's eventually plans to develop that acreage, and hopefully in the near future. And then, of course, when drilling permits are filed, that's a really good indication that there's, in the next couple of years, they're planning on drilling that. It's on their drilling schedule, and they're just getting things lined up with drilling contracts and with, all the land and title things, and then getting ready to bring a rig over to start drilling. So there's definitely ways to pretty easily see what the plans are. Now things can change. Price of oil crashes, and all of a sudden it's no longer economic to drill those wells, and that may never get drilled. But all things being equal, you can sort of see what the plans are for that company, just because there's a lot of publicly facing documents available through through oil and gas leases that are filed in the county, through those pooling documents and other things like that you can see and have access to.
Maybe if we could talk about just the economics of underwriting the deal, and maybe give us just some rough examples, right? Maybe of a conservative deal, and then a moderately successful deal, and then maybe a home run, and what that looks like. So you're coming in and you're not buying the surface rights, you're just buying the mineral rights. So the party that you're buying them from will retain ownership of the surface. Talk through that a little bit on however you're on a per acre basis, or how you evaluate those.
Yeah, so it obviously, the ideal situation is if you could get the minerals without paying extra for them, right? They're just part of the deal, and you see that, and you can sever that. Now, if it's in an area where there's oil and gas activity, they probably signed an oil and gas lease. They know there's value there. They're going to either want to hold on to them or want some value for those minerals. And so you're going to have to figure out, to your point, what is that property worth? And there's really two elements to that. Generally speaking, we do a discounted cash flow analysis on minerals and look at if there's producing wells. You forecast what those wells are going to produce into the future, have a price deck on future oil and gas prices, and then tie all that together, add up all those cash flows and then discount them to today's date to figure out what it's worth. And for producing minerals, we typically use about a 10% discount rate on those. That's what the industry, that's sort of the market price for those producing minerals, or for the producing portion of those minerals. Now, if there's, for example, one well on a property, but there's room for maybe 7 other horizontal wells, there's some value in the undeveloped acreage as well, but the value is highly dependent on the time frame of when those are going to get developed, and it's all time value of money. And so you're looking at, okay, if there's a rig on site, those are very you have a very good line of sight to when you're going to start seeing that royalty stream start to come in, and so you can base your valuation on that, and it might get closer to the 15% discount rate or 20% discount rate is sort of the target for those real line of sight to future development. Whereas maybe you're in an okay area but you really don't have indication that an operator is going to drill, next year or the year after. Some of the metrics we look at is, you can kind of leverage what the Securities and Exchange Commission, they have guidelines for underwriting, for valuing oil and gas assets, just because of some reserve scandals that happened about 20, 25 years ago. So they have a very well-defined set of guidelines for what companies can book, what they can book in terms of those proved reserves, and it has to be that they have a credible plan of development in the next 5 years. And that's typically if you're within 1 to 2 miles of existing drilling, you can assume that they're looking at it in that time frame and in that category. So you'd be looking at probably closer to, I'd say, between a 20% discount rate to 30% discount rate. And if you're really conservative, because that they have to have that plan to drill in the next 5 years, you might say, well, 5 years from now is when that royalty stream is going to start up, and then you can discount again at 20 to 30% to figure out what the value is for that undeveloped portion. Now, it takes some proprietary software, some somewhat knowledge, some basic knowledge of oil and gas well behaviors and what kind of a curve you want to fit to that production profile and how to come up with what those future wells are going to drill, because you're basically using analog wells near where that development's occurring to figure out what the future wells are going to do. So you sort of take the average of everything that's happening nearby that's of the same characteristics, the same type of well in similar vintage, in the last few years, let's say. And then you can use that as a proxy for what the future wells are going to do in terms of how much oil and gas they're going to produce. Some of that's, somewhat specialized knowledge, somewhat being streamlined by, different software and things like that. And there's some tools that are out there that if you're really getting into this, it's helpful to have some basic understanding of how that's done. And you could do that yourself, or really the best thing to do is hire a petroleum engineer and, get a relationship with them and have somebody that can help underwrite in an area. And they don't have to do every deal, but they can help you get a feel for, like you said, okay, here's the home run, it's got permits on it. Here's really what the value per acre is for this type of property versus the one that's out there. And it's in a good area, but it's a couple of miles away and there's no permits or no lease yet. Well, maybe it's in this area, in this ballpark of price per acre. And again, there is one rule of thumb I will say that is somewhat helpful, although you have very limited number of properties, but this actually would be a good thing to base an investment decision on, but that is the multiple of cash flow. So if you do have a property that's like fully developed, wells are more than 5 years old and there's no prospect of any future oil and gas development, then you can use between 36 to 60 months multiple of monthly royalty payments is a way to figure out what that property is worth. But there's, obviously that assumes whatever they've been getting paid, in terms of commodity prices, that's going to continue. So you have to have some measure of knowledge of what you are basing this investment decision on in terms of underwriting the deal, in terms of oil and gas prices, in terms of how fast these wells are depleting and things like that. And that may adjust, where you fall in that range as to how much you're willing to pay. But that's a general rule of thumb. If you're looking at like a back of a napkin, that's really kind of the only thing that I'm aware of that you can use. Everything else, unfortunately, is kind of more of a nuanced case-by-case example, because every property can be very different. You can have one property that's worth $25,000 an acre with 16 horizontal wells going to start producing tomorrow, and there's one a mile away it's never been leased. There's nothing really imminent, and so that one is going to have a very different value profile. So,
when you're going to go and buy one of these mineral rights, I guess like you're going to buy the mineral rights. Are you oftentimes buying the land, the surface rights at the same time, or are you usually just buying the minerals underneath?
Yeah, most mineral investors are only interested in the minerals underneath. That's kind of their business. They're doing those types of deals. A lot of them are buy and hold. Some flippers for sure that are speculating if they can get in and buy something and then flip it. You mentioned earlier at the beginning, can you get in there and not put money down? And it is possible that you get a contract for minerals, and if you assign that to somebody. They'll pay you for that and step into the deal and put up the money and pay and close the deal. And so you could potentially do that. There's all kinds of extremely creative ways that oil and gas deals are done for sure.
Well, yeah, with land, it's kind of a calculator. It's like 1+1 = 2. You can see a path to getting to, I guess, profitability and paying yourself a wage and making it an actual full-time vocation. I mean, you're doing it now full-time and you were working for a large company before. How long does it take someone to maybe create like a livable wage out of full-time investing in minerals?
It would highly depend on how much you're starting with in terms of money. I mean, you could potentially parlay stuff over time into bigger and bigger deals. The thing that's interesting about minerals is that you have an idea of what somebody owns, but maybe you don't really totally know until you run title in terms of the number of net acres. You might come across somebody that's interested in returns, gives you a phone call or returns an email or a form letter you send out, and they're interested in selling, and all of a sudden they have 160 net acres and it's in a highly desirable area, and you're going to need to, pony up, $1 million or, something like that. And so you're going to have to find and build relationships, I think, in the industry to be able to, you know, sell down those types of deals or have partners that can come in on those types of things. That's kind of the interesting thing with minerals is it's highly dependent on how many net acres. If you find somebody that's got a quarter of a net acre, well, that's an easy one to take down yourself, and it maybe is only a few $100s you're paying for it. If you're willing to do the work, yourself and lower risk, and that's obviously where you'd probably want to get started is on some of those smaller deals, so that if you strike out or you screw up on the title and they don't really own as much as you thought, well, you're not betting the farm on it, so to speak. But yeah, I think that's if you're, if people are interested in learning about it, there's industry events that you can go to. I've served on the board of the National Association of Royalty Owners. And that's a great place to get educated. That is sort of the mission of that organization is advocacy and education. And so, you want to learn about the nuances of minerals and royalties, sign up to attend the convention in your state, or our national convention, and sit through presentations from experts to learn about the space, for sure. And then I do have an online course as well that goes through the very basic aspects of minerals and royalties and some of the basic underwriting and due diligence steps around running title, and learning that process. And then also learning to navigate the state oil and gas commission websites to look for, here are the documents you need to look for, and here is what you want to see when you find that property on a map. What is the indication that there's activity going on and things like that. So all of that is helpful too, and just having a bigger picture view, broad view of what these types of properties can do, and what the potential like relative value is as you're doing due diligence on these types of properties.
Can you buy any type of land and or minerals under any type of land? How much do you guys factor in the surface? Like, are you buying minerals underneath a established shopping center, or do you just say, no, that's not happening because of what's at the surface?
It depends on the area. As an example, one area that maybe those minerals under that shopping center might be actually have a chance of getting developed was in the Barnett Shale in the Dallas Fort Worth area. That's kind of the where a lot of this started with horizontal drilling and hydraulic fracturing, and that's a very urban environment, as you could imagine. But there's the Barnett Shale goes right underneath that urban area, so there's quite a few wells that are that have been drilled. And with horizontal drilling, if you have open land, like farmland that's a couple of miles away, well, it's possible they could place the surface location for that well pad there and then drill those wells horizontally 3 miles under that shopping center. So it may be that those minerals are valuable. If it's in an area where they're never going to drill a well because it's too close to like a city, and there's not going to just put, certainly in today's day and age, they're not going to put an oil well in downtown Denver, for example. So yeah, but there may be some value in the minerals underneath that parking lot there, but it's probably never going to get developed. And so you have to really kind of weigh the specifics of each deal and looking at, is there going to be prospect of future drilling or future activity and getting some being able to monetize it.
Well, the last question that I've got for you, I actually randomly came across this, and Matt, I live in Golden, so we're close to each other. But a guy I play tennis with, he works at Stantec, and we were talking about our land business, and he was asking me if we had ever used basically kind of like a conservation easement grant, where you are taking a tax credit for foregoing the ability to monetize the minerals in your property. And have you come across that at all on any of the properties that you've dealt with? I mean, I'm curious from a strategic standpoint. You go in, you buy a property for the mineral rights, and then maybe the price of oil or gas, changes dramatically, and then your property is really no longer economically viable for development, right? But you still have those minerals under there. And so do you explore the opportunity that maybe you can value those and take a tax deduction, or kind of offset some of your tax liability based off of that?
I haven't heard of that being done, although a case could be made, and this would be more of a takings claim. So under your constitutional rights, the big issue we're facing with, or certainly where there's opposition to oil and gas development, I think in Colorado, just as an example, just north of you in Boulder is a great example of that, where eastern Boulder County is right adjacent to where, not far away from Weld County, where a lot of the oil and gas drilling is occurring in Colorado, and highly valuable mineral rights. And a company had proposed drilling wells under the county line. So the surface location was going to be in Weld County, which is, they're favorable to oil and gas. They like the tax revenue and all of the things, and so they're generally willing to work with oil and gas operators on development. While Boulder, did not appreciate the prospect of fossil fuel development under their minerals, even though there was, a couple of miles away is where the well location was, and those wells are more than a mile underground, so there's no impact to the surface at all. So it was just more of a philosophical issue that they had with fossil fuel development. And while they were successful in creating enough of trouble for the oil and gas company, that they just gave up that project. They said, well, we could do this and we could develop this and force the hand and go through and force pull the county lands that were underneath those wells, but it's not worth the PR nightmare and all that stuff. We'll just move on and we'll just go do something else. And so in that case, if you owned minerals in Boulder County where that company was going to develop those minerals, you could, I think, justifiably have a takings claim against Boulder County. There's value to that mineral, to those minerals, that is tied to the ability for you to develop them and to receive a payment for, the production of oil and gas in this case. And if they're blocking that development, that's the real thing that's, I think, probably going to get challenged in the courts in the next couple of years. And it's going to be, until once it goes in front of the Supreme Court, then they'll decide once and for all what the appropriate mechanism is for that. And if you condemn mineral rights, then there is potentially value there that you could write off, to your point. Whether you call that a conservation easement, if that's what happens nearby, and then you can't develop your minerals because it's part of that as well, or something like that, that's possible. But mostly it would be involuntary. I'm not aware of perhaps, I think it's possible if you had a big enough tract of land where you controlled the destiny of the development of that. So it'd have to be enough, like thousands of acres type of a situation, where there'd be no way that anybody could co-develop your mineral tract with other acreage. So that even if you had 5 net acres and you said, I don't want mine to get developed. Well, you could get force pooled potentially, and you really have no, that's nice that you didn't want it to happen, but it's happening and you'll get your fair share of that, whether you like it or not. But so that tax write-off doesn't really apply in that type of situation. So it's kind of a unique situation in that I don't know that there's like perhaps the only exception to that would be if there's carbon capture, carbon sequestration occurring where they're like, that would be the only time when they would like literally prevent any future development is, in that formation where they're storing carbon, you can't drill through it because it could release the CO2 and there's tax credits. Now, if you're putting your minerals into that project, then maybe there's some tax credits in terms of those CO2 offsets or whatever that you could sell or something like that could be valuable. I haven't dealt with that before, and I think that perhaps that is purely a construct of tax code that was created with the 45Q tax credits, and if those go away, then that whole scheme goes away as well. So it's not. I don't know that it's like a permanent thing. I feel like we're going a little bit away from that as a way to make money. It's as it's in and of itself. So it's going to be interesting to see how that plays out, though.
Selfishly, I got a few tactical questions I want to ask you before we hop off. So you've got a course on mineral rights. What's the course? I'm looking at your website here and I see resources. I got education up, and it's Mineral Management Basics. Is that your course?
That's right. Yeah, it's Mineral Management Basics. Basically the whole point is to understand the basics around minerals and royalties. And there's lots of nuances. We've been talking today around the different aspects of the mineral estate. So I go through introductions of the different types of oil and gas interests. So it's not just mineral rights. There's different types of royalty interests that can be created, but from both the leasehold as well as the mineral estate. And so I go through all of those, how it all fits together. I talk through all the different important documents that are related to minerals and royalties. And so certainly from a due diligence point of view, the documents you'd be looking for and the county records and checklists of all of that. And then how to go through and search those records and, run sheet examples where you can record all of those different transactions and that chain of title. And then, of course, how to actually go into the State Oil and Gas Commission website and figure out, what the oil and gas potential is for that property based on where current activity is. And the things that I have that I would say that to be looking for from a mineral investor, I go through on how to, find copies of oil and gas leases. So if you have a landowner that you're dealing with that has signed an oil and gas lease, that could be a good indication that they do own the mineral rights. It's like a little bit of a clue. And so a lot of this is just doing a lot of sleuthing and piecing the puzzle pieces together to figure out what happened over time and then what this person actually owns. And there's lots of signs that you can use as indication to go further. Okay, maybe we do want to do a full title search, or we want to actually go down the road of valuing these minerals and figuring out what we want to do with them. So
a lot of land investors build teams, and they'll create a research team, and then they'll have people that do outreach or figure out a way to do outreach without the people, which a lot of times we're using direct mail. We'll send a lot of direct mail out to people that own land and say, hey, do you want to sell it? But we'll text, we'll cold call, stuff like that as well. And then there's, oftentimes acquisition managers on the team, due diligence folks, all that kind of stuff. How many, when you're working with, new clients, I mean, what is a typical personality profile that lends itself well to minerals? And also, like, are you having people build teams? Do you have a team yourself? Is it a one-man show? What's a typical operation look like?
Yeah, I will say that the typical profile of somebody that I think can be successful in oil and gas is very similar to those that are successful in land investing. And by that, it's, those same things that you're doing with land investing, you're doing those basic outreach steps and trying to get the weeding through the different landowners that are, willing to sell you minerals. And so in this case, you're dealing with a a separate Rolodex of mineral owners that are maybe under those same tracts of land, maybe totally separate people because of that ability to sever the mineral rights. And so, it is the same thing. It's sending a lot of form letters, it's cold calling, emails, text message, things like that to contact people to see if they're interested in selling their minerals. And it's the same things that you're talking about. So I think people that are successful on the land side can be successful in minerals. They're willing to pick up the phone and make the phone call to, catch somebody. And a lot of times it's catching somebody at the right time for them. They may have been told to hold on to their minerals forever, and that's great. But then if you have medical bills you're dealing with or something where you're like, well, I actually kind of need to sell this. The nice thing with minerals, it's very interesting, is you don't have to sell 100% of it. You can sell half of it. So there's always a pathway to have a conversation with somebody. It's like, well, we'd love to buy half of your minerals. If you want to hold on to half of it and see what happens, but you need some cash now, you can hold on to half of it and we'll buy half of it, and then we can, jointly, see what happens, and hopefully something that we both benefit from. So there's lots of different ways you can go about it. And again, I think with the team, that's a great approach. Certainly as you're getting started, if you are interested in minerals, is to find people that have done this before and to learn from them. And to get that team of trusted advisors that can help with certain aspects that maybe is not your zone of genius. If you're great at picking up the phone and making phone calls and doing the sales side of things, but then running title, that's like the last thing on earth you'd want to do, then, partnering with a good landman that knows the area, maybe that's local there, or at least has done a lot of work there and is, has the relationships and those kinds of things, can be huge. And you can leverage their expertise and knowledge around, well, here's this title issue that we have to deal with because of this language and this deed over here that was recorded 50 years ago. Well, we actually have to reopen probate because there's this long lost half brother that's out there that has claim to this thing. So we got to go through a quiet title suit. And as the mineral buyer, you're really deciding what your tolerance is for those risks and how much you want to take on. And a lot of mineral buyers, they have the title attorneys and the landman that can help them identify those issues and resolve them before closing, or that you can get out of a deal if there's something that's going to prevent you from enjoying the benefit of those minerals because of some really hairy title issue that you just don't want to deal with for a quarter of a net acre, and it's going to cost you $6,000 with an attorney to go through a quiet title suit. Well, maybe you're going to pass on that deal and say it's not worth it, or take the risk on and say, well, we're just going to not pay anything for it, or like pay a very small amount. And if that rears its ugly head, then, well, we're not out that much and it's not really that big a deal. And that risk profile, you have to kind of figure out what you're willing to tolerate, and then having people to guide you as you learn this industry is very helpful to prevent you from making a catastrophic mistake and perhaps paying for minerals that person never owned, and you don't have any recourse. You're sort of stuck, depending on how you structure the deal and the language and the deed and all those nuanced things that having an experienced person can really help you with. So I guess kind of to summarize that, key people on your team are, having an attorney that can help draft deeds or help review deeds and purchase and sale agreements related to these types of transactions, having a landman that can help you with running title or reviewing title once you've run it yourself to help you understand the language and deeds and what to look for and things like that. And having an engineer or somebody that can do the valuation side, certainly as you start to underwrite these the first few times, to get a feel for that process, what they think about in terms of putting value on different scenarios and things like that can be very helpful. And then, attending industry events as well to build that network of other mineral buyers up, because again, there'll be stuff that you come across that maybe you can't take down yourself, that you want to partner with somebody else, or they'll have deals that they pass on, but then, they know that you're interested in that area and you can get sorts of deeds or deals that way as well. So
it seems like there's a lot of opportunity for either someone that's in land investing already to, take your course, let's say, and add this to their quiver, if you will, and say, okay, cool, we know how to do this now, and it's another tool in our toolbox. Or maybe there's, marriages that can take place between, if you're a land flipper in an area that's really rich in minerals and there's a lot of activity going on, maybe you sync up with, someone that's like yourself that specializes in minerals in that area. And if you guys find deals that you can work on together, there's an opportunity to, take down both or extract max value from the land. I mean, how common is it that the surface rights owner owns the minerals underneath?
I would say in rural areas, and certainly where there's like a long history of, a farm or a ranch, or, it's um, perhaps they do own both. As you get into um, more urban areas, a lot of times the developers will hold on to the minerals, and they'll be severed, and they'll sell the house and the surface rights. And so when you go buy a house and, subdivision or something in a suburban area, then a lot of times you don't own the minerals under your house. That was sold, when they bought it from the rancher when he sold it, and then the developer held on to the minerals. So it just really depends. That said, there's parts in Weld County, like we talked about earlier, in Colorado, where there's a subdivision that there are wells under, and each of those individual homeowners owns a quarter of a net acre, a quarter of an acre, and they own the minerals under that tract. And so just very much it depends. There's really no like set in stone type of rule. So it is possible that you're doing a deal and you could own the minerals, or they could own the minerals under the surface. And if and that's the situation, it doesn't hurt to get to sever those if you're flipping that land. In my mind, if you might as well hold on to the minerals. Even if nothing happens, you're not out anything. It could be worth holding on to see if oil and gas is found in that area and something happens. Great thing is you can, again, pass it down to your kids, and they can pass it down to their kids, and maybe in their generation something will happen with it. So it's kind of a unique asset along with land, other real property.
Yeah, Michael and I are hoping that one day a letter will come in and
Yeah. Well,
someone, but we're not holding our breath, Matt.
yeah. Yeah, it just depends. I mean, you can sort of figure it out. Like I said before, if you're looking at the state oil and gas websites and you see where their drilling is going on, and if it's relatively near where that surface land that you're doing, then it's probably worth paying attention to for sure.
Sounds good. All right. Well, we're going to link to a bunch of stuff in the show notes for ways to reach you. But before we end, just go ahead and, if you could, share some of the easiest places for people to find you online.
Yeah, so my website, mineralrightspodcast.com, we publish shows just about weekly. We have four episodes per month is kind of our normal cadence. I have a free newsletter you can sign up for, where I go into a little bit more in depth on each week's episode, provide some additional insight. And then when the show notes, we'll link to the course as well, if you're interested in learning more about the basics of minerals.
Cool. All right. That sounds great. Well, Matt, thanks so much for coming on and sharing the world of mineral rights with us. And yeah, would love to learn more.
Yeah, really appreciate it, Matt. I mean, it's so much knowledge, and it's such a unique niche. But I mean, with a lot of our audience being land investors, it's something I think that, like Chris said, they could come in, they could take your course, they could just get a fundamental understanding of what mineral rights are and where there might be opportunity, and then you never know. They may hit a home run, or they may find that they really have a knack for being able to sniff out mineral right deals, and it turns into another vertical for them.
Yeah, for sure. I think it's certainly, if you're a land investor, it's helpful to understand and to know what to look for to see if somebody might own minerals. And so I think what you can get out of the course is to sort of put those pieces of the puzzle together as you're doing diligence on a land deal, to see the indications that somebody might own the minerals. And certainly in areas where there's oil and gas activity, that's a valuable thing to pay attention to, and not to try to pass up that opportunity. So Yeah, hopefully this has been helpful, and happy to answer any questions people have. You can send me an email too. I'll throw that out there. Feedback at mineralrightspodcast.com. So somebody listening to this has a question about anything, happy to give you some high level guidance on where to go, get some information. So yeah, hopefully that can be helpful as well.
Awesome. Well, thanks, Matt. It's been fun.
Yeah, thanks again for having me. Enjoyed it.
Thanks, Matt.